Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this hour with Michael Green. He is the chief strategist at Simplify Asset Management. Michael, thanks for joining us here on this Black Friday. We'll let you get to shopping in just a second. But I do want to start, before we get to the broader market, I do want to start with cryptocurrency for a bit here, because this really has been one of the big barometers of the risk-on sentiment that we've seen over the past few weeks. Kind of started even before the election, but of course picked up a lot of steam once people got a look at what is going to be a new Trump administration in January. You see this momentum continuing?
Well, I think the real question is, does the buying continue, right? So we've seen extraordinary inflows into products like BlackRock's Bitcoin ETF. We've seen an incredible innovation, in quotes, right, the classic financial innovation with the single stock ETFs that have powered entities like MicroStrategy over the past month or so. Those seem to be running out of gas, and the financing costs associated with them, I think, kind of give lie to this idea that financial conditions are affected in any way, shape, or form by what the Federal Reserve is doing right now. But this is clearly one of these things that is indicative of both people's expectations that the craziness is only kind of going to accelerate as it relates to government spending or inflation or the risks associated with the Trump administration. And
as people sort of take a look at that, Michael, and they try to sort of make bets in the crypto sphere, we've seen a lot of people looking for proxies to do that. MicroStrategy, of course, was the proxy for quite some time. We started to see ETFs come into this space, and we started to see more of an embrace, not only by retail investors, but by the institutional set as well. Do you expect that to continue? Do you expect the embrace of crypto to be much more through these proxy vehicles rather than through the actual crypto asset itself?
Well, I think this actually tells you something about the space, right? Which is that there still is very little utility associated with the actual tokens themselves. Ultimately, this idea of digitally native securities is incredibly important. It really is an incredible innovation to think about changing away from our still paper-based financial system to one that's really built around digitization and securities that are capable of having complex instruction sets embedded inside them. But right now, we're basically just trying to build enthusiasm for the space. And that is clearly being driven by promotional activity. We see that across the space, everywhere from BlackRock on down to the extremes of the Michael Saylors.
Well, let's talk a little bit about these MicroStrategy single stock leverage ETFs. I want to jump right into the weeds here because, as reported by Bloomberg's Vildana Heinrich, you're seeing this really interesting dynamic where they can't get their exposure through swaps anymore. They have to basically tap the options market and buy these call options. And there's been a lot of concern about that, but I want to ask why. What is the end effect on the end client, or is this more a problem for the issuers?
So there's two separate components associated with it. One is it is clearly an issue for the issuers themselves in that their prospectuses do not disclose the use of options. And so by attempting to maintain their investment mandate, moving away from swaps into options, they are incurring costs in pursuing their investment strategies that are not fully disclosed to their investors. That potentially creates liability at some point in the future should these begin to underperform. By my calculations, the financing costs are somewhere in the range of 5 to 10% per month at this point. So while we sit here debating the idea, should the Fed cut by 25 basis points, we're seeing areas of the market that are being propelled by speculation with interest rates closer to 100%. So it really is not anything to do with the Fed at this point, I would argue. The second issue that you have is that financing cost, because it ultimately means that these vehicles are facing a bleed associated with a failure of those options to go further into the money or deliver against their volatility. that means that the carrying costs of these products are also in that kind of 5% plus 10% area, meaning that the Bitcoin market and the MicroStrategy market has to continue to rise at nearly 100% a year in order for these products to break even. That's a very, that is an incredible headwind, and a lot of the behavior that we're seeing in these single stock levered ETFs, I think ultimately we're going to find out will be treated as various forms of manipulation, and in all likelihood, we'll see this stuff pulled off the market at some point in the future.
Well, we'll see. That would certainly be dramatic. But to put it simply, of course, these are not meant to be buy and hold investments. The issuers themselves would tell you that. But I want to talk, too, about the relationship between these leveraged single stock MicroStrategy ETFs and what it means for the actual MicroStrategy underlying stock. Because you see MicroStrategy trading at a record premium, I believe, to Bitcoin itself. And there's some theories out there that it's actually these leveraged single stock vehicles that are driving that.
Yeah, I don't think there's any question about that. If you look at the increase in premium that occurred, it happened almost simultaneously with the launch of the largest of these levered ETFs, MSTU being the ticker there. That actually very clearly powered this separation. There's very little to actually debate around that's allowed it to push itself beyond Bitcoin. Now, what that's created is something similar to what happened with Grayscale Bitcoin Trust a year ago, or 2 years ago, in which a premium that it developed for Grayscale Bitcoin Trust created demand for Bitcoin. This is working almost in reverse. The premium for MicroStrategy is leading to MicroStrategy being able to issue shares and in turn buy Bitcoin. It's a far less direct route, but it's the same underlying effect that continues to power both the stock and the coin, the token, higher at this point.
And just real quickly, Michael, I am curious that when we start to, we were talking about this in the context specifically within the crypto sphere, does some of that optimism, does that bleed out into the broader market? I mean, can we take cues from what's going on in the crypto sphere for the rest of the market?
I think it's hard not to assume that there are going to be implications associated with this, right? So you have individuals who are investors in Bitcoin who are feeling flush in the environment that will lead to them increasing their purchasing activity, et cetera. So there are real world feedbacks to this. There's also very real world feedbacks in the kind of the classic George Soros reflexivity component. This type of price activity facilitates MicroStrategy going out and raising real cash in the form of convertible debt, or issuance of shares, which in turn is used to purchase that Bitcoin.
Yeah.
They could theoretically hold on to that cash and use it for alternative corporate purchases, as we saw with stocks like GameStop or with AMC Entertainment. So far, Saylor seems to be much more aggressive in this process.
All right, Michael, great stuff. Going to leave it there. Have a wonderful rest of your week and weekend. Michael Green over at Simplify Asset Management.
Conversation going with Jill Standish. She is head of retail over at Accenture Global, joining us now. And Jill, I want to go to this line in your notes. You write that retailers have good reason to be cautiously optimistic, which is interesting because we talk about all of these headwinds potentially coming at retailers next year. What is the case for optimism right now?
Well, in our survey, which we did right before holiday, basically people said they're going to spend upwards of 4% more this year compared to last year. So that's the optimism. The cautious is about the fact that everyone's looking for a deal. I mean, you heard in the other correspondent's point, everyone's out there for Black Friday because they know that there's sales on today.
Sales on today, but we were joking earlier that Black Friday, it's really a state of mind. It never ends. I was actually out and about on Tuesday getting great deals as well. I mean, this bleeding out of the bounds of Black Friday, what does that ultimately mean for retailers? Because it seems like it's just persistent discounting.
Well, listen, agility is being put to the test this year because shoppers have only one less week compared to last year because it's where Thanksgiving fell. So retailers were really smart. They said, listen, I'm going to start doing my discounting early so I can get people to start shopping early. And listen, AI has been on the pitch for a long time in retail, where retailers were planning out when to put things on sale. So that hopefully will help them make sure that they don't lose margin over this period. It's all being worked out through advanced technology, which is great to see.
I am curious just about how much some of these retailers can sort of prod the consumer into buying certain things. I mean, some of us, Jill, we have a hard time figuring out what to buy what to buy for our loved ones. You know, what gifts do they really want? And I know some retailers have taken a more creative approach kind of to really put out these gift guides and create other experiences when they're in their store to sort of plant those seeds in your head, probably for the more expensive stuff. But still, what are they doing?
Yeah, listen, this year is the year of curation and recommendation. Retailers know that people are getting inspiration from all different sources, whether that's Instagram or Meta or Facebook, you name it. There's a bunch of places where people are getting suggestion. Some of the curation is happening not just in the store with really smart people working the store saying, here's what you should buy. It's also happening with technology. So think about if you're online and all of a sudden this little pop-up comes that says, hey, do you need any help? Who are you buying for? What are you looking for? What's your budget? Those types of recommendations is going to be what the future looks like in retail. So instead of you trying to search, people are trying to help you. Trying to make it easy on you.
I am curious, too, with regards to physical stores and the idea of a lot of these physical stores trying to find ways to get people back in. We were just checking in with Macy's in Herald Square here in New York, which, of course, just really decks out a store. I mean, you go to that store just to see the displays, and hopefully you buy something along the way. I know Bloomingdale's right across from Bloomberg headquarters here also has these pretty expansive displays. Are we seeing these stores embrace that more? Because there have been some stores that said they're actually pulling back. Saks said they're not doing their normal light show this year.
Yeah, you know, stores are back this year, which is fantastic. You heard that stat that said there's a bunch of folks that are going to be shopping in stores this year. And so there is that retail shopping fun where you get together with your friends and you go to the stores. It's not so much about the decorations as much as it is about that feeling on Black Friday or Cyber Monday, going in and going shopping. I think the key for retailers this year is going to be all about, again, curation, recommendation, and then let's not forget the store staff. Frontline workers have been really part of the equation. I always say you can have the best discount, the best promotions, the best curation, the best assortment, but if that person behind the till is not in a good mood, it could really, really change your opinion of that retailer.
Amen.
So frontline workers is also something that retailers are taking care of this year.
Yeah, it's a great point that service matters. I want to go to another line in your note because I thought this was interesting, that retailers are focusing on inspirational content, which actually can improve sales according to your data. What is inspirational content, though?
Well, listen, I talked a little bit about AI, and AI has been used a lot of times with figuring out, again, your assortment, figuring out how best to make sure that the supply is right, also how to get it to the store. And then, of course, you're using all sorts of AI for doing curation around your ads and your promotions. But now, because of advanced technology, now the way that you advertise is also being inspirational. So you can have more tailored advertising to consumers now, which is fantastic, a lot because of Gen AI. So that's what I mean by inspirational. And also, gift ideas, suggestions, recommendations, that's on the pitch this year. It's the year of curation. You know, I always like to say, where do people get their inspiration? Do they get it from, you know, looking at Instagram? Do they get it from going on the website of the retailer? Most retailers are saying, listen, I've got to play a big role of making sure that eyeballs come to my website. How do I get them there? Maybe I do have some ads on Instagram to get you to click through to come to my website.
Absolutely, all about tantalizing folks. Jill Standish over at Accenture.
Keep the conversation going now with Judy Dempsey. She is non-resident senior fellow for Carnegie Europe, joining us now. And it's great to have you with us, Judy. Put us into the shoes of European leadership right now, confronting the possibility of less American support for Ukraine, the possibility of increased tariffs here. How does one prepare for that?
It's very difficult. I mean, there's so many unpredictabilities, but clearly President-elect Trump wants to move very quickly. He's actually chosen a former general to be his envoy, General Kellogg, to be the special envoy in Ukraine, who will try to conduct negotiations. But the Europeans, they say they want to stay at the table. Well, I'm not so sure they're going to get one. And secondly, if the Trump administration does actually reduce its military support for Ukraine, will the Europeans be ready? There's a shortage of material already. Some countries, such as the Nordic countries, are supplying as much as they can, and some other countries are running short, and some other countries of the EU are a little bit reluctant. So they're not really prepared, but they have been warned of the day after when Donald Trump enters the White House. And maybe Ukraine is depending on the Europeans for more military support. It's going to be very difficult to muster this very quickly.
And let's talk about the possibility of tariffs here, because, you know, we make jokes about French wine and German cars, for example, but you think about the balance of the European economy right now, and particularly the car industry, for example, which has been under some pressure here. I mean, how much would tariffs hurt? How should we be thinking about that?
The tariffs are an enormous worry for the outgoing German government particularly, and the incoming one, whoever that will be. The real issue is that Donald Trump has a kind of difficult relationship with Germany. He sort of resents its huge export surplus, and the tariffs, 10% tariffs, is very, very high. At the moment, trade between the Eurozone and the United States is about $450 billion a year. And this has actually increased over the COVID times, when trade between Europe and China sort of declined. So the Europeans are increasingly relying on the US market. So you slap tariffs on and they still want to export, it's going to be very, very difficult for them. The other key point is that how the German automobile industry will react. We've seen announced closures in Volkswagen. We've seen the steel industry going to lay off 6,000 or 7,000 workers. What will happen to avoid tariffs? German manufacturers will probably go over to the United States, which is exactly what Donald Trump would like. But if that happens, it could have a negative spin-off effect for the economies of Europe, because it would mean more job losses and probably less competition.
Judy, I'm curious. I'm not unsympathetic to the challenges that Europe faces in the face of a new Donald Trump administration. But there are a lot of questions, at least from the U.S. lens, as to why Europe wasn't better prepared for this. They've had time. They knew this was a big possibility. And now here we are talking about what, at least on the contour, seems like a surprise to them.
You're talking in the sense of the Ukraine issue?
Ukraine issue, tariffs,
everything.
Yeah.
Yes, you're quite right. Yes, to use a terrible phrase, the writing has been on the wall, but the Europeans, they do talk an awful lot, and they talk about competitiveness and diversification from China, but they're really not prepared for the tariffs, firstly. Secondly, I think we really have to remember that the European economies are not only going to be hit by the tariffs, they are actually going through a period of deindustrialization at a rather fast pace, largely because of the China influence, what China has done to the electric cars, for instance, but also the whole element of digitization, AI and other issues. The Europeans are incredibly slow to embrace these, and that's another contributing factor for being unprepared for this new kind of transatlantic relationship.
And it raises another question, too, about just how common, if you will, the common Eurozone is. I mean, this is a collection of countries that I don't think have really acted in commonality for quite some time. I don't think they ever did, but they at least managed to put up a good facade for some time. But I think we've seen, with regards to the ructions in France, Germany, and of course what's going on the Eastern Europe, that there just isn't a lot of consensus. So how do you get to a solution?
It's very difficult. And what we've seen over the last, say, 10 years is the increasing role of the member states vis-a-vis the role of the executive, the European Commission. And now the member states, whether it's France, whether it's Germany, whether it's the Netherlands, whether it's the Baltic countries, they're all looking after their national interests. And if you look after national interests, you actually downgrade or make the whole idea of the European Union weaker. There's no talk anymore about integration. There's not even any discussion about what's really necessary. is completing monetary union, such as a banking union. And so in some ways, the European Union as an economic project and as a political project has really slowed down, and there's no leadership either in Berlin or Paris and other countries to say, let's put our national interests behind us and try to integrate the European Union further so that we can deal with the new challenges coming from Washington, from China, and of course, Russia and India.
All right, Judy, got to leave it there. Really appreciate you taking the time. Great to get your perspective. That is Judy Dempsey of Carnegie Europe.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.